In this video, I'm going to demonstrate how to do problem 10-2A from our textbook. It is on pages 348 and 349 of the book. So in this problem, we are looking at payroll, and we are going to complete what's called a payroll register, and we're going to make a couple of journal entries related to the payroll. So I'm going to read this narrative. Country Covers has 4 employees and pays them on an hourly basis. During the week beginning June 24 and ending June 30, these employees work the hours shown below. Information about hourly rates, marital status, withholding allowances, and cumulative earnings prior to the current pay period also appears below. So we've got a list of the 4 employees' names. We have the number of hours that they worked. We have their hourly wage rate, we have their marital status, the number of withholding allowances, and their cumulative earnings prior to this pay period for the year. And then if we look at the instructions, there are 9 steps we're going to go through in this problem. First one says to enter the basic payroll information for each employee in the payroll register, record their name, number of withholding allowances, marital status, total and overtime hours, and regularly hourly rate. And we are to consider any hours worked beyond 40 in the week as overtime hours. So let's get started. So on the screen right now I have a blank copy of the payroll register, and the first thing we need to do is put on some dates onto the form here. So we need to look at the narrative to remember when the week began and ended, as well as the pay date. So taking a quick look back at the problem, we can see that the week began on June 24, so we can put that in the payroll register form. And the week ended on June 30th, so we can also place that on the form. And then finally, there is a spot for the pay date on the form, and that isn't given at the beginning of the problem, but if we go down to the 9th step, it says that we're paying the payroll on July 3rd, so that would be the date of the pay date. So that would go on the form as well. So after that, then we just basically got to copy over a bunch of information from the table that's provided in the book here in terms of the employees' names, how many hours they worked, their hourly rate, and so on. So let's do that real quick. Boom, that's done. So now we get into some detail here, and we have to do some calculating. So for this first employee, Roma Brandon, they worked a total of 48 hours this week. And what we need to do is figure out, well, how many of those hours are going to be paid at the regular rate and how many of those hours will be paid at the overtime rate. And it told us in the narrative to consider any hours beyond 40 in the week as overtime hours. And this sentence also implies that all hours up to 40 hours during the week are regular hours. So what we're going to do first here for Roma Branda is calculate their regular earnings. So to do that, we're going to take their regular rate per hour of $11.50 according to the table, and we're going to multiply that by 40 hours because they worked a total of 48, so they had 40 regular hours. And if we do that math, that gives us a result of $460. Next, we can see that since Roma worked a total of 48 hours and those hours over 40 are overtime hours, they worked 8 overtime hours. But before we can figure out the overtime earnings, we need to also figure out the overtime rate. So to do that, we take the regular rate of $11.50 per hour, and we multiply that by 1.5. And the reason why we do that is called time and a half. And that's what we're going to always assume in this class, is that the overtime rate is going to be paid at time and a half the regular rate. That standard comes from a law called the Fair Labor Standards Act of 1938. And that law only applies to firms engaged directly or indirectly in interstate commerce, so it doesn't necessarily apply to all businesses, but time and a half is a pretty common practice for overtime, and that's what we are always going to assume in this class. So if we do that math for the overtime rate, we can see that Roma Brandon is going to earn $17.25 per hour for every hour above and beyond 40 for the week. And since Roma worked a total of 8 overtime hours, we're going to multiply their overtime rate of $17.25 by those 8 hours. And if we do the math there, that gives us a result of $138 of overtime earnings. So lastly, we need to find Roma's total earnings for the week. So we just add up the regular earnings and the overtime earnings. So 460 plus 138 gives us total earnings for the week of $598. So now that we've done the math related to Roma's earnings for the week, we just need to transfer that information to the form. So we put in the regular pay, the overtime pay, as well as the total earnings for the week. So I'm going to give you a couple of moments. So why don't you pause the video and see if you can calculate the regular, overtime, and total earnings for the 3 remaining employees. And I'm back. So if you want to take a moment and check your results against mine for the 3 remaining employees, I've also shown some of my work down below. Another thing that we should do as we fill out this payroll register form is to add up all of these columns with dollar amounts. So I need to add up the cumulative earnings prior to this week, as well as the totals for the regular overtime and total earnings for the week. So now that I've calculated each of those 4 totals, now I'm going to move on to the next column, which is another cumulative earnings column. But this cumulative earnings includes this week's paycheck. So prior to this week's paycheck, so from January 1 through June 23, the day before this week began, Roma Brandon had earned a total of $16,975 before taxes. That was Roma's gross. During the current week, Roma earned $598. So what I need to do now is add that $598 to their prior cumulative earnings to get the updated cumulative earnings, which include this week's pay. And we need to do that for all 4 employees and then total that for the bunch. And just to make sure that I'm absolutely clear here, I am going to take Roma's cumulative earnings prior to the week of $16,975, add the total earnings for this week of $598 to get a total of $17,573, which I place in the cumulative earning column in Brandon's row. Then we follow a similar process for the remaining 3 employees to get their cumulative earnings after this week's pay, and then we also place that into the table. And finally, we would sum those 4 totals to get the total cumulative earnings of all employees through the end of this pay period. So the next section of the payroll register form that we're going to be taking a look at is the taxable wages section. And the first tax that we're going to be talking about is Social Security tax. Social Security tax was created out of the Great Depression, and it was part of FDR's New Deal. And Social Security tax is designed to provide income to people when they reach retirement age or if they become disabled before retirement age. So there is a limit that we need to be aware of in relation to Social Security tax. And if I pull up the Social Security Administration website here, I can see that the maximum taxable earnings each year for Social Security tax change every year, change most years, I guess. It's adjusted based on cost of living. In the textbook, they said that they're always going to use 2019's limit of $132,900, but as you can see, that limit typically increases as cost of living goes up. This limit applies to each individual employee's earnings for the year. So if they earn over the limit amount, then the employee's earnings are no longer taxable once the earnings reach that amount. So we're going to use that $132,900 as our limit in this problem. And what we should look at first is the the cumulative earnings prior to the current week, and we see that no one was anywhere near $132,000 individually. And then also after this week's pay, none of the employees are anywhere near that limit. So what that tells me is that all of this week's paycheck, the gross pay for each employee is going to be fully taxable for Social Security. So the first person in our list here, Roma Brandon, they had total earnings for the week of $598, and because their cumulative earnings have not exceeded that limit, all $598 are going to be taxable for Social Security this week. And the same pattern is going to be there for all employees. Now, if we had an employee that had cumulative earnings prior to the week that exceeded that limitation, then we'd show zero here because they had already reached the limit and would no longer have Social Security taken out of their paycheck. Now, also we have another pattern. If the cumulative earnings prior to the current week were below the limit, but this week's paycheck put the cumulative earnings above that limit, then some of the paycheck, some of the gross pay from this week would be taxable for Social Security. And what we'd have to do there is compare the limit against the cumulative earnings prior to the current pay, take the difference to figure out how much would be taxable. That gets a little complicated. I suggest taking a look at an example where the limits actually apply. They didn't really apply in this problem because everybody was below that limitation, even including the current pay period's wages. So I've copied all of the employees' gross wages for the week over here to the taxable wages under Social Security because none had exceeded that limit, and then I'm going to also total that column. So the next column in our payroll register report is our taxable wages for Medicare tax. Now, Medicare tax is closely related to the Social Security tax and is designed to provide health insurance benefits to those people who retire or become disabled before the statutory retirement age. And the Medicare tax is actually applied to all gross pay. There is no limit like there was for Social Security. Now, the book doesn't mention it, but there is actually an additional Medicare tax of 0.9% for high income earners. The additional Medicare tax kicks in when earnings are over $200,000 for taxpayers filing as singles and over $250,000 for taxpayers filing as married filing jointly. The book doesn't get into that though, so I'm just going to ignore it, but I wanted to mention it in case anybody was interested. So since there is no limit on the amount that is taxable for Medicare, the taxable wages for Medicare will always equal the total earnings for that pay period. So I'm just going to copy that information over to this area, and then I'm going to total that column, and of course because those amounts are exactly the same, the total will be the same as well. Finally, under taxable wages, we have a column for, it's labeled FUTA, that stands for the Federal Unemployment Tax Act, and the unemployment taxes, we have both federal and state unemployment taxes, are designed to provide unemployment benefits to those people who become laid off. And the FUTA and SUTA taxes are not actually deductions from employees' paycheck. These are taxes that just the employer would pay. The textbook in Chapter 10 does mention these taxes. They both have a $7,000 limit because each of these employees had already exceeded $7,000 for the year prior to the current pay period. The wages of each of these employees would not be taxable for the unemployment taxes because they had already reached that limitation. So we would show zeros in each row for these employees. In Chapter 11, we're going to go into more depth on the federal unemployment and the state unemployment taxes, but I did want to mention them here. They are discussed briefly in the text in Chapter 10. All right, the next area of the payroll register form is looking at deductions from the employee's paycheck. And we have 3 columns here: Social Security, Medicare, and income tax. And that's going to be our federal income tax. We'll look at them one at a time. So our Social Security tax. Now, we already looked at the Social Security taxable wages. So that's the number of dollars out of the gross pay that we're going to be assessed a tax for Social Security. Now we actually have to calculate that tax. The tax rate for Social Security has remained at 6.2% for many years, so that's what we're going to be using in this class. And we would just multiply that rate by the taxable wages for Social Security for that particular employee. So for this first employee with the last name Brandon, they had $598 of taxable wages for Social Security, so I'm going to multiply that by the 6.2% rate to get our dollar amount of Social Security taxes to be deducted from their paycheck. And when we do the math, we're going to want to round to the nearest penny if necessary. And in this case, we did need to round, and that gives us a Social Security tax of $37.08 to be removed from Brandon's paycheck. So we put that on the form, and then we do a similar calculation for all of the remaining employees' taxable earnings for Social Security. I'm going to pause the video for a second. You can try that on your own and check your results against mine. So I'm back with those amounts, and you can check your results against mine. And then lastly, I just need to add those deductions from Social Security up and show the total on my form. But before I move on to Medicare, I do want to make a quick mention that Social Security tax is deducted from our employees' paychecks, but it is also matched by the employer. So both the employee and the employer pay into the Social Security program, and they would pay the same amount. So the employee is having $37.08 removed from their paycheck. The employer is also matching that contribution to Social Security in the same amount. Same thing is true of Medicare. The Medicare is deducted from the employee's paycheck and also matched by the employer. Which brings us to the Medicare calculation. So what we're going to do for Medicare is multiply the taxable wages for Medicare by the Medicare rate. And that rate has also remained constant for many years now at 1.45%. So in the case of Roma Brandon, we're going to take their $598 that were taxable for Medicare according to our payroll register form and multiply that by the 1.45%, which is a decimal number, is 0.0145. And if we do the math, that gives us a result of $8.67 when we round to the nearest penny. So we just throw that on the form. And then we follow a similar process for the taxable wages for Medicare for the remainder of the 3 employees. And once we've done those calculations, we just put that information on the payroll register form, and then we finally total that column. That brings us to our final column in the deductions section of the payroll register report, which is labeled income tax, and specifically that is referring to federal income tax. To determine the federal income tax to withhold from each of these employees' paychecks, we are going to use what is called the wage bracket table method. And in order to be able to use that method, we first need to look at the employee's marital status as well as the number of withholding allowances. The way that the company would get that information from the employee is by asking them to fill out a form when they were hired called a W-4 form. And on that form, they indicate their marital status and the number of withholding allowances. And if they want anything additionally withheld from their paychecks, they could put that on that form as well. So Roma Brandon, we can see, has marital status of married and has 4 withholding allowances. Also, in order to use the wage bracket method, we need to look at the gross earnings for the period, which are $598. So $598, married, for withholding allowances is what we need to go to our table. So in the textbook on pages 332 and 333, we have some federal withholding tables, and we can see that this table is for a single person that is paid weekly. We'd have different tables depending on how often the employees are paid as well. In our example, it's weekly. But the person that we're looking at, Roma Branded, was not single, so we're going to need to find the married table, which we find here. And if we recall, the number of withholding allowances for Roma Branded was 4, and then the gross wages for the week were 598. So it says here if the wages are at least but less than, so basically it's a range, and we had to figure out which range does $598 fall into, and we have to remember that this is our column as well for our withholding allowances. So based on that information, it looks like we're going to be withholding $20 from Roma Brandon's paycheck this week. 598 fell in this range, and this was the column for 4 withholding allowances. So $20 is going to be deducted for federal income tax. So we can put that amount on our payroll register form, and then I'm going to pause the video here for a moment and see if you can figure out the withholding of federal income tax from the remaining 3 employees. So I'm back, check out the amounts that you came up with and compare them against mine. And now we just need to total this column up. Now in this example, these 3 taxes, Social Security, Medicare, and federal income taxes, they were the only deductions from these employees' paychecks. However, in real life, you may have many more deductions than just this. If we were working with employees who were working in the state of Michigan, we'd probably also have a state of Michigan income tax deducted. And in Michigan, there are several cities that deduct an income tax. And if we look at this web page on the State of Michigan website, we can see that there is quite a long list. Some local cities that charge an income tax include Grand Rapids and Walker, as well as Ionia and Muskegon do as well. So there are local income taxes that could possibly be deducted. In fact, if you lived in Grand Rapids but worked in Walker, well then you'd have both Grand Rapids and Walker income taxes deducted from your paycheck. You might also be wondering which states have a personal income tax. Most do. There are, at the time of this video, there are 8 states that do not. They're here in this list: Wyoming, Washington, Texas, Tennessee, South Dakota, Nevada, Florida, and Alaska. And also New Hampshire does have an income tax, but it limits it to interest and dividend income and is not assessed on wages. In addition to taxes that can be deducted from employees' paycheck, there are almost an unlimited number of non-tax deductions that can be withheld from employees' paychecks. If you think about it, you could have 401k contribution, you could be part of a union and have to pay union dues, maybe you have to pay parking at your work and that comes out of your paycheck, maybe you have to pay child support and the court has garnished your wages, that could come out of your paycheck, maybe you make charitable contributions to the United Way, that could come out of your paycheck. There's an almost infinite number of different possibilities there. In this simple example, we did not have any of those non-tax deductions. We just had the big 3. And you should always watch out for the big 3 coming out of the paycheck: the Social Security, the Medicare, and the federal income tax. Okay, so we've almost reached the end of this payroll register. What we need to do now is figure out each employee's net pay. This is each employee's take-home pay, how much their actual paycheck will be for. And to determine that, what we do is we take the employee's total earnings for the period, their total gross pay, and deduct all of their deductions, and that's going to equal the employee's net pay, their take-home pay. So, for example, with Roma Brandon, they had $598 of total earnings for the week. And then they had 3 deductions from their paycheck. One for Social Security of $37.08, one for Medicare of $8.67, and finally one for federal income tax of $20. So we're going to subtract those 3 amounts from the gross pay to arrive at an amount of $532.25. So that is Roma Brandon's net pay. I'm going to put that on the form. So if you want, you can pause the video and take a moment and calculate the net pay for the remaining employees. So I'm back with those amounts. Check your work against mine. I've also showed my work down below. Last thing I need to do is total this column, and we're almost there. We're almost done with this payroll register form. So the next column is showing check numbers, and the narrative for this problem did not provide us with those check numbers. Those would be the check numbers of the individual paychecks issued to each employee. So we are going to leave that column blank. And then finally, we have a column for the wages expense that will be recorded in our journal entry, and that is just going to match up with the total wages for the employees for the week, and that's their gross pay for the week. So I'm just going to copy that over here, and we have completed our first payroll register form. Now, once we've completed this form, our next step is to make a journal entry to record the payroll for the week. And the good thing is, once we've completed one of these payroll registers, we can very quickly do the journal entry. So the journal entry to record the payroll is going to have a debit to our wages expense in the amount of the gross pay. And if we go to this payroll register form, we had that total wages expense already calculated for us. So that's what we're going to see on our first line, is we're going to debit our wages expense to increase it. Also, the date of this paycheck is going to be the last day of the pay period, which we get from the payroll register form June 30th. So that's where I got that date. So once again, that first line is going to be wages expense for the total gross pay of all the employees for the week. The next thing we're going to look at are the deductions from the employee's paycheck. So we go to the payroll register form and we go to the deductions section. And the first deduction we see was Social Security tax. And we're just focusing on the totals here. The total amount deducted was $142.29. So the employer is withholding that amount from the employee's paychecks. Well, the employer doesn't get to keep that amount. They have to remit that to the government. They have to pay it back to the government. So when the employer withholds taxes from the employee's paycheck, that creates a liability on the employer's books. The employer owes that amount to the government. So that's what we're going to see here, is an increase to our liability for our Social Security tax. And to increase liabilities, we need to credit them. So that's what we see, a credit to Social Security tax payable in the total amount of $142.29. The next tax that was deducted from the employee's paycheck on the register was Medicare, and the total amount deducted was $33.28. Once again, the employer has to pay that to the government, so the employer has to increase a liability account for Medicare taxes. So we credit Medicare tax payable in the amount of $33.28. And then our final deduction was for federal income taxes in the amount of $152. So that also has to be paid to the government, so we're going to increase a payable for that. We'll call that employee income tax payable, and since it's increasing, it is also credited. Lastly, we need to look to the net pay column here, and the total net pay was $1,967.33. So what we're going to do with that is show that the employer owes that amount to the employees. The paycheck date is actually July 3rd, so on this date of June 30th, we are accruing the payroll. So that means that we're recording it, but we're not actually paying it. We're going to increase a payable in the amount of the net pay to the employees, and we will call that wages payable. So that makes our debits and credits equal our journal entry balances. And now we are to the final step in the instructions, and it asks us to prepare a journal entry to summarize payment of the payroll on July 3rd. So this is where we're actually cutting checks to employees. Now technically there would be separate journal entries for each paycheck that was issued, but they wanted us to summarize, so we're going to make one journal entry for all of these payments. The date of that payment is on July 3rd, And since we are paying the employees, we need to show that we no longer owe the employees. And in our previous entry, we had created a wages payable. Now we're debiting that same account to decrease its balance to zero to show that we no longer owe. And then finally, we are paying the employees. We are giving them money. We are reducing the business's cash, so we need to credit cash. All right, we made it through this problem. It was a long one, I know. Since I did problem 10-2A in this demonstration, I would strongly suggest that you try problem 10-2B on your own. And I have placed the solution manual to the textbook in the resources folder on Blackboard so you can check your work when you're done.